So let's talk about tokenized money. Stable coins outstanding
Oh, over 300 billion last time I looked.
and banks on the blockchain of Ant International, the whale blockchain.
Yeah, a significant number, including the likes of Standard Chartered, HSBC, and others.
And what about the global convergence on stablecoin rules
I'd say divergent, but still with a hope of converging over time.
and interoperability across platforms?
To be solved, still fragmented.
And so where do we stand?
Momentum is clearly building up and things are really moving fast at the moment, but still, I think we have a lot more interesting developments to come.
So let's try and unpack this. I'm your host, Efi Pylarinou, and today I'm delighted to discuss a topic, deep dive into the future of digital finance. And what is it about right now? The future of tokenized money. McKinsey says that by the end of this decade, 2030, we could approach 2 trillion of tokenized money markets. Whether that's right or wrong, is it an underestimate, an overestimate? Who knows? But what is true right now is that we have accelerated technology in this area, especially at the level of the infrastructure. And we want to look at topics like the regulatory frameworks, interoperability. Do we have a common language? Where do we stand? And with us today is a unique guest at the intersection of research, regulation, and industry developments. 𝗧𝗨𝗏 is a fellow at the Cambridge Center of Alternative Finance at the University of Cambridge. He chairs there the Digital Asset Research Program. He's also a member of the Bank of England CBDC Technology Forum. He's on 𝗧MA, Investor Trends and Research. He wears many hats. And today we're here to talk about a recently released extensive study, Tokenized Money, Use Cases, Interoperability, and Regulation. And we'll have the opportunity to discuss with Keith the global insights. Welcome, Keith.
Thank you, and thank you very much for the invitation to join your podcast. I appreciate it.
Let's start about discussing this common language. Do we have a taxonomy for tokenized money, this umbrella term? And I know there's a lot of people are using terms interchangeably without realizing that there are significant nuances.
Indeed, when we started planning our research report and what we wanted to dig into, and we very much wanted to look at different forms of tokenized money, so stablecoins, tokenized deposits, deposit tokens, CBDC, etc., we realized there really wasn't any single taxonomy that we could use as a structure. At a high level, we probably all have, a lot of people have a view as to what a stablecoin is and how it's different to a tokenized deposit. But once you go down a couple of levels, it gets a lot murkier in terms of having the clarity of definition. So we struggled to find any pre-existing agreed taxonomy, which is why we felt we could advance the discussion by developing something ourselves. So this was something that we did early on in the research project and obviously published as part of the research report you mentioned. And we tried to do this by looking at four, I won't go into too much of detail there, but looking at four initial dimensions. So understanding the nature of the claim that the digital money may have is the claim against in that respect, the nature of the backing assets that support the whatever the form of digital money is. The third is the form of the digital money itself, and then access, who can actually access it. Obviously, that is different between wholesale and retail and a whole range of different categories there. So that was the basis of the work we did, and you'll find more detail in the report. And we hope it complements and that helps advance some of the efforts that are going on within the broader financial services community, such as 𝗥𝗏𝗄's ensemble, which is also developing a taxonomy more broadly for digital assets. And we've been collaborating with them to understand how we can stay as aligned as we can be between their work and the work that we did in our paper.
And obviously, these taxonomies are influencing regulatory frameworks and future policies and vice versa. There's a shaping that's going on and is very live, correct?
Yeah, very much. We touched on fragmentation or divergence, I should say, a little earlier. And as we have significant differences in the way that different forms of digital money are regulated across different jurisdictions, a kind of prerequisite almost to try and have greater level of convergence is to make sure that we're all talking about the same thing. So that's where a taxonomy, I think, can play a significant role in converging, knowing what we're talking about, and therefore applying the most appropriate set of rules as to how they can be used and regulated.
What are the main jurisdictions that you looked at for that purpose, both because they are developing or have developed to some degree regulatory frameworks, and because obviously they attract more market participants because of that?
Yeah, exactly. So we looked at a number across Europe, obviously, with MiCA and the position that's got. I touched on HKMA earlier, so we also looked at Hong Kong because they've obviously made significant moves as far as stablecoins are concerned. Japan and the Japanese FSA, Singapore because of the leadership role that MAS has had, and then the USA in terms of the Genius Act, etc. So those are the major jurisdictions. And in the report, we talk a little bit about how there are differences in terms of the regulatory approach, both in terms of nature of reserve assets, in terms of its composition, where they need to be located. And obviously with international movement of stablecoins, that's a key question, how they treat overseas stablecoins and whether they've adopted additional existing regulation in order to provide the regulation for stablecoins, or brought in place new bespoke regulation, as is the case with MiCA, with Hong Kong's approach, etc. So a number of kind of differences that we see. And again, as I said a little earlier, there's significant scope in order to provide a bit more convergence as far as the regulatory environment is concerned.
And in the report, you're really going in depth and kind of ranking where they overlap, converge, where they diverge, and really to get a very nuanced picture.
Yeah, exactly. Yes.
Of
And as I said, hopefully this will continue to inform the regulators, and we've had a lot of interest from the regulatory community in terms of the work we've done. And hopefully this will further the cause of getting to appropriate levels of regulation and clarity in terms of the individual jurisdictions and how that will help the industry grow in that respect.
Yeah. Some harmonization, and also to address the other issues that we'll touch upon later about monetary sovereignty, because that's connected. Let's look at what you've identified as the main use cases, because you've interviewed, from what I understand, for the report, both market participants and regulators. So you have a really global, circular view of what's going on.
Exactly. As you say, we interviewed banks, stablecoin issuers, and regulators just to understand what the different perspectives were in that respect. And particularly it was interesting to understand what banks see as the use cases which are evolving and having most impact versus the regulators' view as well. So there was a reasonable degree of alignment, I think, there. But as cross-border payments turned out to be the #1 use case in that respect, it's not particularly surprising, obviously, in developed markets where there are already faster payments environments that are already working on a very efficient basis. The cause is a little less required than it is for cross-border payments, which, as we know, can be held up by banking hours, can have a high degree of fees associated with them.
Correspondent banking,
exactly,
traveling.
exactly.
Yeah.
This came across very strongly as a key opportunity, really. And as you may have heard on our webinar yesterday, we had Ant International on our panel, and they talked about how they've made extensive use of tokenized deposits in order to be able to transform their treasury operations on a global basis. And that, I think, sets the example for other corporates to understand just how significant it can be to use stablecoins in particular as a means of delivering real-time, low-cost payments, be it stablecoins or tokenized deposits. Obviously, Ant are using tokenized deposits, but other institutions are looking at stablecoins as a means of doing this, and the means by which that can really add a significant value in terms of liquidity management, making sure that cash isn't sitting idle, not earning income because of bank holidays or weekends, etc.
Yeah. I find that the case of the international blockchain whales very interesting, and it's not so well covered in the Western media. And it is very unique compared to JP Morgan's Kinexys, which is operating within a banking system. It serves clients of JP Morgan, and they are quite scaled relative to other permissioned or closed networks. But Ant International is very unique because it's not a bank, and their banks are willing to come on the network and facilitate basically the movement of payments that is supporting the commerce business of Ant. And that could be an example for other
Absolutely.
Western places. Can I ask something in terms of this use case? Isn't it correct to say that it is, for now, more on the business side rather than the retail side? So we're talking.
Yes. Yes. Yeah. And our main focus on the report was B2B transactions rather than retail. So that's true.
Yeah. And then after cross-border payments, what's the second use case for tokenized money, if you like, that you've identified?
Yeah, we saw 3 other use cases that were particularly focused on in that respect. Obviously, there's the question of trade finance, so how this can be used in terms of trade finance in that respect, being able to optimize liquidity across the board. And so the whole treasury liquidity management element as well, which kind of complements what I was saying a little earlier in terms of cross-border. In trade finance, this was highlighted by one bank in particular, because as you may know, within trade finance, there's a litany of failed blockchain projects that were trying to use blockchain technology to automate the whole trade finance lifecycle, but using the conventional existing fiat money structures that existed. Now, obviously, with stablecoins and tokenized deposits, there's a means of being able to have all those, the cash side of these transactions on chain, which opens up trade finance digitization as well. So that was a third topic. And then the final topic that we talked about as well was capital markets infrastructure. So basically, the role that digital money can play on chain as a settlement asset for tokenized securities. So there are some examples here. London Stock Exchange has just announced what they're doing with their digital market infrastructure and how they'll support on-chain digital money as part of that. Obviously, others are looking at stablecoins as a means of providing a settlement asset on-chain. And whilst this is all waiting, I guess, to some extent to see what central banks offer and announce as far as wholesale CBDC is concerned.
Yeah, what the stock exchanges are doing, I find very interesting. Deutsche Börse recently acquired Allfunds, and if you look at it, it's an ecosystem play because they have custody, they have brokerage, they have their own stable coin, and they're trying to create that end-to-end cycle to be able to issue easily. From what I understand, they're more focused. They have been focused on digital warrants, but 𝗨𝘀𝗲 is also moving. So these are big players that are moving. What about the tension between permission networks and open networks? For example, and the whale from Ant, they're all permissioned walled blockchains, but we are seeing tokenized money market funds like BUIDL and the one that Moni, that JP Morgan launched. They're going on the open networks, be it Ethereum, be it Base, be it the other layers. What do you see there from your report, the tension and the tendency of the market?
Yeah, I think there's an overriding direction that we're seeing towards public permissionless chains by solving some of the challenges around privacy and how KYC can be implemented in that kind of context. So obviously there've been multiple initiatives along these lines, but they're having to overcome these kinds of problems. So for example, if you're using Ethereum as a public permissionless network and you're doing digital bonds issuance and the cash side of that as well, the risk is that you may be using gas, which has actually come from a sanctioned entity in that respect. So there's quite a few things that need to be resolved in terms of how public blockchains can fully support that, given the regulatory differences, I think, which have caused, as you said, BUIDL and so on the buy side to be able to take advantage of public chains, because the regulatory side is on the buy side has been less of an issue than it has for major investment banks and commercial banks, and particularly on the US entities that have had to use whatever private permission chain in order to comply with the regulatory expectations, but also take advantage. The risk obviously is there that private chains just add to the fragmentation. We end up with islands in that respect and bigger interoperability challenges as opposed to what public chains can deliver. So I think the problems there in terms of privacy, KYC, how you implement AML, etc., are going to be resolved over time. And it's then a question of this migration that we'll probably see from private chains to public chains as soon as both the regulators get comfortable with public chains to a greater extent, and how some of these key issues are going to get resolved by the industry as well.
And I guess this is a big shift then, compared to what was happening a couple of years ago, where the market, the institutional players wouldn't want to hear or discuss about public change, right?
Yeah, exactly. But we're seeing shifts. 𝗨𝘀𝗲𝗄𝗏 has been a very early adopter of public chains in terms of what they've been doing, and they are very much, I think, a pathfinder for some of this. You mentioned JP Morgan, but obviously they've recently announced that their JPMD deposit token is available on Base and whitelisted for all the reasons we talked about before, but still on a public layer 2 in that respect. And obviously there's the Canton network as well, which is a public network, but permissioned again. So finding solutions to address those regulatory requirements without getting too much of a walled garden, which is the challenge with some of the implementations.
Does the report look into the different consortia that have been formed over time? Some of them have really failed, others are still alive. Does the report look into this, where they are and what their role is?
In terms of interoperability, you mean?
Yeah.
Yeah, very much so. With tokenized deposits, as you touched on a little earlier, if a certain bank A issues a tokenized deposit, the challenge is, can they transact with a corporate who also has a banking relationship with bank B? So how do you build these interoperability networks to be able to settle across institutions? Which obviously public chains already implicitly do. So obviously, yes, to the answer to your question, we looked at a number of those, including Partior out of Singapore initially, which now has a number of banks that are supporting it, which is making progress in this area. The challenge is the network expands a bank at a time. So obviously it needs to continue to build that network of banks in order to have the required network effects. Likewise, there's RLN, the Regulated Liability Network. Obviously, some initial POCs in the US, but in the UK, we now have a pilot running later in the year, which will be supported by all of the UK banks, which will have tokenized deposits, the GBTD, I should say, tokenized deposits that will be running on that for 3 initial use cases. And likewise in Germany, the tokenized deposit effort that has been going on there is due to go into pre-production later this year. The challenge there is you end up adding a country at a time because these are largely domestic networks. Therefore, to solve for the international business, they need to join up with other country implementations, which is obviously a challenge. And that's a challenge that is obviously being tackled by a project 𝗥𝗚𝗏, supported by their BIS, 7 central banks, over 40 financial institutions. But there again, there's another challenge. It's obviously a long-running project looking at both CBDC and tokenized deposits, trying to allow correspondent banking to take place on a much more efficient basis. But BIS isn't likely, I think, to be the entity which will run such a network in production. So the question is, how does it really move from a POC or pilot into some production entity, which will be a pretty critical FMI in some respects, and who will actually run that and take all the requirements in terms of operation, resilience, security, and so on, to do that on a global basis. So understanding what the end state is the challenge there. So all these ones I've mentioned have their particular challenges, as I said, but they're all heading in the right direction. It's going to be really interesting, I think, to see which one will actually make the difference as far as this global financial substrate that Tony McLaughlin talks about sometimes, in order to make that vision practical in that respect.
Now that you mentioned, Tony, this issue of being able to clear all these different types of tokenized money is also part of the big puzzle that needs to be solved to have that interoperability. Because imagine not only all these stable coins, then all sorts of different tokenized deposits, all sorts of tokenized money market funds, and how do you avoid the fragmentation there and really to unlock the value where the potential is.
Yeah, absolutely.
100%. The other big topic, Keith, is the fact that we didn't talk about that in our initial sort of exchange of topics. There's a risk here that 99% of stable coins are dollar-backed stable coins, and that is really of concern for monetary sovereignty, given the world, the markets, the use cases there. How do you see that? Do you see that we can work on that. It's a chicken and egg problem. How do you create liquidity for other stable coins with other currencies?
Yeah, no, that's I think a real challenge. And as you say, 99 point large number percentage of stablecoins are US dollar based. In Europe, I think last time I looked, it was around 650 million, which is a small portion of the 300 billion of market cap of US dollar based stablecoins. And here in the UK, it's even worse. I think circa 5 million, tiny numbers. And there's only one or two stablecoin issuers that have been approved so far. But in the UK, the regulation is due to be implemented September, October or so next year. So that the one or two issuers that are out there at the moment are pretty bullish, I think, in terms of how they see market cap growing. So the first point I'd make is it's also the developed economies such as the EU and the UK, for instance, which have faced this challenge as well, to what extent their domestic stablecoins can grow to play a significant part rather than seeing more dollar dominance. And for emerging markets and developing economies, as you say, also a challenge because obviously there may be less local confidence in the local fiat at that point, and the dollarization becomes a much bigger risk, especially as some of the applications and some of the startups that are focusing on this have no choice but to use US dollar-based stablecoins for some of the innovative propositions they're developing, which further causes the kind of dominance of dollars in that respect. So I think for MDs, it's in particular a challenge for those that have got relatively weak currencies with the way that the digital money and the broader digital infrastructure is developing in that respect.
Keith, what is the one thing from all this extensive report, which I invite our listeners to check it out? There's great interactive maps and analytics and infographics that you can deep dive into and learn all about the players. There's a huge section about programmability. We could have a separate session on that one. But what would you say is the one thing that you want to leave listeners with from this report? What would it be?
I think from my point of view, two things, if I may. So one thing is we touched on regulatory divergence and convergence. I think over time, every regulator I speak to sees the need for greater levels of convergence, and that will obviously help the broad international development of digital money and the role it can play in the future economy. How that delivers and develops over time, I think, is super important. And also in the broader context, stablecoins and more broadly blockchains will fade into the background to some extent. They'll become the back end means by which innovations are delivered. And I think from a retail point of view, that it will not be as visible in terms of technology because the innovation is taking place at the front end, and the fact that stable coins are being used or tokenized deposits are being used will not be that obvious and doesn't need to be that obvious. So I think that will help broaden the adoption in parallel to what I said on the regulatory side.
But you clearly see that most of the use cases right now are at the B2B level rather than the retail level.
I'd say both. Looking at tokenized deposits in the UK, the GBTD initiative has two retail use cases and one wholesale use case. The one in Germany is largely wholesale based, serving corporates. Stablecoins obviously have a role to play in terms of international remittances and that kind of thing, which is very much a retail side. But also have roles to play, as we said, in corporate treasuries for B2B. So I think it's a combination of both, and it remains to be seen how those evolve given the different competing forms of digital money. And we haven't even really touched on CBDCs yet. So that's going to be particularly interesting, I think, in the EU, where obviously there are tokenized deposits initiatives by country, stablecoins growing, as I mentioned, including the bank consortium as 𝗧𝗲𝗏, which has a significant number of banks issuing a stablecoin together now. And then finally, the digital euro, which is hitting a pilot next year, apparently. So how this will actually work in practice, it gives a very nice experimental playground, if I can say that, for other countries to take note of as to how this may develop in future.
So Keith, what keeps you excited for 2026 before we close?
All of this. We have much more work to do on tokenization and digital assets, a fascinating area, and looking forward to doing more with the banks, the regulators, and the broader industry of fintechs that we're collaborating with in that respect.
And do you feel that this is happening parallel to the AI
transfer? Oh, we haven't even touched on that. And obviously the whole intersection between AI and digital assets is a huge thing. Agentic AI, using stablecoins in particular as a form of digital money for all the agentic payments that'll be taking place. This is obviously a huge area. I did hear somebody at a conference yesterday say that because of the risks of an AI bubble, AI investments may be declining, which creates more investment for digital assets. Whether we'll actually see that in practice remains to be seen. But I think that intersection will be a fascinating area of development over the next year or two.
I totally agree. Thank you so much, Keith.
Thank you very much.